Liquidity risk management, the crucial role of asset liability management in banks. In the banking industry, liquidity is a critical factor that determines the health and stability of financial institutions. Liquidity risk management involves ensuring that banks can meet their financial obligations when they come due without incurring unacceptable losses. One of the key strategies in managing liquidity risk is asset liability management, or ALM. What is asset liability management? Asset liability management is a systematic approach used by banks to manage the risks that arise from the mismatches between assets and liabilities. These mismatches can affect a bank's liquidity position and overall financial stability. ALM aims to optimize the balance sheet by ensuring that there is enough liquid assets to cover liabilities while maximizing profitability. This involves careful planning and monitoring of cash flows, interest rates, and the overall economic environment. The importance of liquidity risk management. Why is liquidity risk management so crucial for banks? Firstly, banks operate on a fractional reserve system, meaning they only keep a small percentage of deposits in reserve. This makes them vulnerable to sudden withdrawals or financial crises. A bank that can't meet its obligations risks insolvency, which can have devastating effects on the financial system. Moreover, regulatory bodies have imposed strict liquidity requirements, such as the Liquidity Coverage Ratio, LCR, and the Net Stable Funding Ratio, NSFR. These regulations are designed to ensure that banks maintain adequate liquidity to survive financial stress and support long-term sustainability. Key components of ALM in liquidity risk management. Cash flow management. Effective cash flow management is the backbone of ALM. Banks need to accurately forecast inflows and outflows to ensure they have sufficient liquidity. This involves analyzing the timing and amounts of cash received from loans, deposits, and investments against the cash required for withdrawals, loan obligations, and operational expenses. Funding strategies. Funding strategies play a vital role in managing liquidity risk. Banks need to diversify their funding sources to avoid dependency on a single type of funding, such as short-term wholesale funding. By utilizing a mix of long-term deposits, equity, and debt instruments, banks can ensure they have stable and reliable funding to support their operations. Stress testing. Conducting regular stress tests is a crucial component of liquidity risk management. These tests simulate adverse scenarios, such as sudden withdrawals or market shocks, to evaluate how well a bank can cope with liquidity challenges. The results inform strategies to improve liquidity buffers and enhance resilience against financial strain. Asset management. ALM also involves actively managing the bank's asset portfolio. This includes maintaining an appropriate mix of liquid assets that can be easily converted to cash. High-quality liquid assets, such as government bonds or cash equivalents, are critical in ensuring liquidity during times of market stress. The role of technology in ALM. Advancements in technology have significantly improved ALM practices. Banks can now utilize sophisticated software for data analysis, risk modeling, and forecasting. This enhances decision-making capabilities and allows for real-time monitoring of liquidity positions. Effective use of technology leads to better risk management and contributes to the overall stability of the banking sector. Conclusion. In conclusion, liquidity risk management is pivotal for the survival and success of banks in today's dynamic financial landscape. Asset liability management serves as a vital tool in navigating liquidity challenges, ensuring that banks can meet their obligations while maximizing profitability. By focusing on cash flow management, diverse funding strategies, stress testing, and proactive asset management, banks can strengthen their liquidity position. Understanding and applying these principles can lead to stronger financial institutions, ultimately promoting a more resilient banking sector. Ready to elevate your treasury expertise? Become a Global Banking Hub member to access exclusive courses, earn certificates, and get personalized feedback. Join now at www.globalbankinghub.com.